Hi and welcome back. Last week we had a look at Judges Scientific. This time we're going across the pond to look at a company called Dutch Bros. With me, I have senior analyst Imran. Well, thank you for coming.
Thank you for thank you for having me on this side of the conversations. It's good to be the analyst this time around versus the person asking the questions. Probably the harder job.
Right. So, last week you published a new report for premium members of the Money Cog, and it was on a company called Dutch Bros. And maybe we can start by just explaining to everyone what exactly this company does.
So Dutch Bros was founded in 1992 by two brothers. So they were Dan and Travis, surname Borsma. And in 1992, they decided they were a family. Their family has a history of being dairy farmers, and they decided to step away from that and say, well, actually, we want to do something a bit different. So they started off with a push cart out in Oregon where they would basically sell espresso. But alongside selling espresso, they would have sort of rock music and the like with these push carts, so people had sort of a sense of feeling good about having their espresso. And they started off with that. And over the number of years, they took that model of push carts and they basically went through drive-throughs. And those drive-throughs, they expanded into both franchises and sort of ones that they own as well. We can talk a bit about that later. But today, as of sort of the end of last year, they've got 538 shops in the US over 12 states, and they are looking to sort of expand. And last year was when actually they did an IPO. So last September was when they had an initial public offering.
How has the stock performed since they went public?
Yeah, so the stock has been it initially went up, as have a lot of the IPOs
Yeah.
in the US. You know, there's a lot of action and people think it's a great stock. It went up. It started up sort of around the 38, 36.68 was the IPO price, and it went as high as 76, and it's come down quite a lot as of sort of last Friday. It's $49. So as we speak, you know, as of sort of the 4th of March, 2022, it's around $49. So it's still up, you know, 34%. So you still would have been up since the IPO, but it's had a bit of a roller coaster of a ride since then. But again, that's not unusual. I think what you
Mm.
find is, you know, we've both seen this is where when a company does an IPO, it's the institutional investors or the investors or the retail investors who get into these investments find it maybe hard to understand the business. So you get opportunities where things are maybe mispriced or misvalued. And
Yeah,
obviously,
we've seen it.
carry on.
We've seen it quite often where IPOs tend to take off on the initial excitement, and then after a bit of time, people absorb the information, they understand a bit better the business, and realize, oh, this maybe isn't worth as much as it is at the moment. And then naturally, we often see the share prices decline. So
Yeah, there has been lots of cases. I think it was Uber was one, wasn't it, where it sort of
yeah,
went down quite a
that's
bit,
a
but
perfect example. Yeah.
you could actually buy it for a lot cheaper than the people who bought it in the private markets. So
Yeah.
if you'd bought it straight away at the cheap price, you'd have made more money than those who had bought at the last sort of private markets round. So yeah, it's a lot of opportunities out there, and that's, you know, a lot of what we do at the Money Cog is finding those great businesses that we think will have long-term growth potential. You know, like we say, those 10x, 100x bagger
Mm.
sort of businesses. But yeah, I think this one was an interesting one actually, because I thought initially the idea came from yeah, as a lot of ideas come from maybe things that you read online or people are discussing, and you say, well, let's have a deeper look of what this business is, and is it actually worth, you know, making an investment.
Yeah, okay. So after reading the report, Dutch Bros is not your ordinary sort of set up a coffee shop and sell coffee. So how exactly does the structure of this company work?
Yeah, so if you think about Starbucks, where you've got, you know, stores all over the world, you go into whether it's here in the UK a high street, or you go into sort of the motorways and there's a drive-through slash a shop model. Dutch Bros is a bit different. Dutch Bros' entire model is entirely drive-throughs. So you
Okay.
go in to have a drive-through experience, and that's what they've basically focused on. And they focused on hot and cold beverages, but purely coffee. They do predominantly coffee, and then they do a few snacks here or there, but it's just known for that. And actually, it's a split. So what they have is they have around 271 shops, which are company owned, and then 265 are franchises. And
It's
the way
like
it works,
50-50. Yeah.
yeah, but what's happened is the franchises have actually just plateaued and stayed flat because the focus has been, their view was that actually they want franchisees to be people who've worked at Dutch Bros or already existing franchisees to open another store, because they want them to be part of that Dutch Bros system. So they're very into the culture and what the business
Mm.
stands for. And because of that, they've actually made it very difficult to own franchises. And actually, you've seen over the years that the franchise numbers has decreased and the companies have increased, sort of quite a bit. And if you look at the franchise model, the way it works is Dutch Bros gets $5,000, he gets $5,000 sort of upfront, and then it gets a royalty fee. Sorry, it gets $30,000 upfront for the franchisee model, and then to start the franchise, and then it will charge 5% on the gross sales that franchise does. So that's the specific franchise model. But if you look, they actually make majority of their revenue still, even though it's 50-50 on their company operated ones, which makes sense because they're only getting 5% on the franchisee ones.
Yeah, that must make sense. We've always seen where we have companies who are strongly focused on their corporate culture, they tend to have a lot more success. It's not hard to see why. If employees are proud of where they work, and so much so that with Dutch Bros they want to go ahead and open their own franchise, then that's clearly an advantage to have. It makes attracting new staff a lot easier, and it also a happy employee is a productive employee, if you like. So if you're feeling a bit of a greedy capitalist, that's one way of looking at it. But obviously, having happy employees is one thing. But how does management intend to expand its operations in the future?
The management are looking at once they've done the IPO, now they're looking at sort of expanding quite aggressively. So they're looking at expanding eastwards within the states. So they're looking at Texas, Oklahoma, and they're looking at sort of 4,000 stores. So right now they've got 530, it's 538. So that would be quite a dramatic increase over a period of time. But those would obviously be drive-throughs, because the model is still drive-throughs. So that would be quite a dramatic, that would be, at least sort of an 8 times increase in existing, um, in their existing stores. You can see some problems with that because that's entirely company driven. So they'll have to have, and part of their model is that they want sort of their staff to run those shops, their company owned ones. So their ability to grow at that pace would be interesting to see. And if they'll be able to achieve that. But what you've seen is they've had a lot of success, and we can talk a bit about the revenue growth in a minute. But they've had a lot of great success with the existing model, and through TikTok and social media, they're getting a lot of traction amongst sort of the sort of Gen Z generation, which are really keen to sort of buy those drinks and share it with their friends on social media, which is drawing free traffic really to sort of free marketing to Dutch Bros.
It's quite a useful advantage to have, and obviously going from around 500 stores today to over 4,000 is quite a growth opportunity if it can hit that target.
Yeah.
We'll see. Well, time will tell whether or not they can do it. But in the meantime, how is historical performance? So if we're looking at the revenue today, has it been growing, and what's sort of been driving it?
Yeah, so let's have a look. I'll show. Why don't we go through the notes? If we go look at our notes, or the note that I sort of wrote on the Money Cog Premium, which you can just get in the description below in this video, you can see how that's grown. So it's grown from 200 million, well, just shy of 200 million in 2018, all the way to looking at sort of 500 million in revenue. And really the jump has been very much, as you can see, the split is franchisee and company, and a company operated shop. So you can see that a lot of it's just been driven by the company operated shops. And that makes sense because it's the margin, right? You own that. So you own the shop, you get all the benefits of every single time someone buys a coffee, it goes straight down to the bottom line. Once you've fixed the costs of running them, it's just very easy for them to get that. It's quite attractive. Whereas in the franchisee one, again, the shops have stayed flat, but they haven't done much in terms of revenue. So it's all coming from predominantly their own shops that they're running as a company.
So expanding on your point you've just made there, with the number of franchisee locations remaining relatively flat and the revenue contributions doing the same, it looks like a lot of the growth is being driven primarily by the opening of new stores rather than increasing like-for-like sales.
Yes.
Do you
So
feel? Yeah.
yeah, I think that's fair, because I think they're looking to, it's a continuation, and I think going into next year they're looking at another 125 stores. So that'll get you another 200 million in additional sales versus having massive increases to like for like sales. And I think the reality is when it comes to these sorts of businesses, there's only so much they sort of make a point where there's only so much you can increase the value per customer, right? Because people's habits don't change from one year to another, how much the coffee they're consuming. There's only so much
Mm.
drinks you can have, right? Any given household. So it's difficult for them unless they can increase the foot flow in the brand. That's where they're going to get the revenue from like for like sales going up. But it's still, I think the issue they have is, and the problem is because they're targeted at that Gen Z generation and they're the ones going there, they probably aren't going to increase that sort of revenue like for like sales unless they somehow appeal to a bigger audience. But does that
Mm.
cannibalize their business model because they're appealing to a bigger audience and then they don't become cool anymore and therefore they lose their
Yeah,
the essence of their culture and their brand.
it's an interesting problem to have, that's for certain.
Yeah,
Okay,
exactly.
so we dived very briefly into the revenue side of things, but in the premium report, which I had a read through before we started recording this, you mentioned a rather strange liability called a tax receivable agreement. I was wondering if you could explain to individuals or investors out there who may not have come across this before.
Yeah, so tax receivable agreements. It was quite. I saw the line and I thought, hang on a minute, there's quite a big sum out here that suddenly comes up as soon as the IPO has happened. They've got this big liability that they have to pay. So I did a bit more digging because I thought, well, that's strange and that's debt. Because both of us, when we look at companies, the issue is sometimes companies like to hide their debt. So you have to
Hmm.
sometimes look deeper into the reports to say, well, actually, this is debt like, and this is something they'll have to pay, and this is part of the business. So you cannot take that out or strip it out of the value. So tax receivable agreements, in essence, are when a company does an IPO, so specifically IPO or exit related, those individuals, whether they're private equity groups or investors, they say, well, because at that point they were a partnership, there's certain benefits that the company gets when they do an IPO, which is basically they get deductions from sort of depreciation and amortization that they can take advantage of, and that gives you tax benefits to the person that to the investors that when it goes to an IPO. So they say, well, that needs to go back to the private investors because they didn't receive that tax benefit because that goes to the new shareholders because you're
Hmm.
reducing your tax liability. So they create this sort of tax receivable agreement amount that they need to pay for, and that's just
It's
coming
a
from just from the sort of non-cash expenses benefits that they're getting
It's
and the
quite
tax.
a sneaky trick that a company can use to make itself look healthier than it actually is, in fact.
Yeah, and also
Uh,
it's another crafty way that private equity businesses get more out of their money, don't they? They do the
mm,
leverage buy, they put the debt on the businesses, and then they take it, they sell it, and then they cash out, and do all sorts of financial engineering to enhance returns.
uh,
But yeah, but I think it's
okay.
something that you need to be aware of. Yeah, that's something they have to be
No,
aware of.
definitely. I mean, if we've always advocated that before any investor opens a position in a business, they should fully understand it. And when we start seeing strange line items on financial statements, it's definitely worth digging deeper. And in this scenario, we discovered, or rather, you discovered, that there was the equivalent of a giant debt liability hiding in plain sight,
Yeah, I mean,
which,
there's another one where the CEO has a $900,000 he spent on buying a plane from the company. I always find when CEOs buy planes or when things go into management get planes, it's always a red flag.
yeah, that does sound a bit dubious.
Yeah,
It's giving me vibes of WeWork, where their ex-CEO, now the original founder who's no longer involved in the business, had quite an extravagant lifestyle and tried enforcing that lifestyle on his employees with a lot of money being basically set on fire. Uh,
yeah.
okay,
As a side, yeah, let's get back on.
let's try putting a bit more of a positive spin on this business. What you've already mentioned briefly about the advantages that Dutch Bros has with its social media presence, but how do you think it stands out in a competitive space where they have to go up against companies like Starbucks, for example?
But I think ultimately it goes back to sort of brand and culture and experiential that you look today at sort of any retailer or any brick and mortar store. People want an experience. People want to go somewhere where there's an experience value add, right? And especially with Gen Z, and what Dutch Bros does successfully is they create that experience, and actually through their through all these people that share on TikTok the videos, it's like FOMO, fear of missing out. So all these other young people want to go to this place because it's a cool place to hang out, and because it's exclusive, because they don't have so many, it it works in their favor. And you can say it can become a disadvantage because if they have so many, it might lose its novelty. And there's also other issues that go with how do they keep current and trending. But ultimately, it's that experiential value that they give, and that's where they're able to win a lot of their customers and create that sort of culture and differentiation amongst what is a generic product, which is just coffee. The other point is their pricing point isn't as expensive as Starbucks, and some people would argue that based on what I've read, that actually Starbucks probably has better coffee, but it's the experience people are buying into with Dutch Bros, and that's what's really helping them sell. So it would be interesting to see how they can expand into 4,000 and whether it works all over the states. But it seems to work. When you look at the United States and as a country of size, drive-throughs are quite common. Maybe here in Europe and maybe less in the UK, it's not as common to have so many drive-throughs, right? It's only
Mm.
location based, and within London, you probably have, unless you're on sort of the greater London, you don't get that as much. But those are the two sort of things that really stand out for me from Dutch. It sort of reminds you of where maybe Starbucks was at the beginning of the days. You could compare. 'Cause Starbucks came up with a new innovative way of having coffee, and they revolutionized coffee and the concept of it, and charging sort of a premium for it. So it'll be interesting to see how sort of Dutch Bros evolves from that. And you never know, it might even become an acquisition target. I think that's more likely than them staying there for longer. Because if you look at sort of Costa in the UK was bought out
Yeah.
by Coca-Cola. There's another company, Dunkin' Donuts, was bought out by Initial Brands in the US. So you've got a lot of companies which are being bought out by the major players, and I
There's
think
consolidation within the
yeah,
industries. Yeah.
and I think that's what will happen. And maybe Dutch Bros becomes, if Starbucks were interested in having a younger feeling brand on their portfolio,
Mm.
this would make much more sense.
It's very fit and very interesting. Let's make the assumption that an acquisition doesn't come along. Though, do you, when it comes to analyzing these businesses, if it really is Starbucks in the early days, which could be quite exciting for investors, then we've got to have a good leadership team on board.
Yes.
So you mentioned you actually had a look at some of the people in charge in the premium report.
Mhm.
As a reminder, there's a link to it in the description if anyone watching wants to go take a look. What were your takes when analyzing the CEO, for example?
So I think just stepping back is, and for our viewers, is when you're looking at ownership stakes, sometimes people go in Yahoo Finance and they look at the ownerships. Sometimes it can be misleading because if you don't fully understand that there's different, what happens is sometimes some companies have different share classes, and share classes have different voting rights and different sort of rights that they can do. In the case of Dutch Bros, one of the founders. So I mentioned earlier that Dutch Bros was founded by two brothers, Dan and Travis, and I think, well,
No.
Travis is still alive, and unfortunately Dan passed away some time ago. So Travis he's not the CEO anymore. He's the chairman, but he's the executive
Okay.
chairman. So he's still got very much say of where everything goes. He probably just wants to enjoy his life now and doesn't want to really do the day-to-day work of a CEO. But he owns what he controls through his voting shares, 74% of the business. So that's quite a lot. And actually, his shares at the time of the IPO, which probably isn't too dissimilar now, where the price is, it was 2.5 billion, so it's slightly higher now. But he's the one really sort of controlling where the business is going. And I've always found, and I'm sure we both do, is when founders, sort of visionary founders, have still a massive stake in the company. That's always a positive because they're the ones that drive ultimately the long-term value. And management having stakes in the business is always a great sign of incentives aligned with shareholders and making sure that everybody's aligned in terms of interests. So those are great. And I think from that perspective, it's good to have somebody who's seen the business through and seen the growth, still be on the leadership. But at the same time, the CEO now, whose name I've just forgotten, but he's come from industry. So he joined the business just before the IPO in 2019. So he's taken the business to the IPO, and he's come from an IPO. He's come from a previous beverages company, so he's got experience to look at sort of businesses. And I think that business was also public markets. So he's got experience of looking at public market companies, because I think the one thing that people forget is when a company goes public, it has to behave differently and has to make different
Mm.
decisions, because you've got suddenly scrutiny of quarterly reports and different sort of approaches, and not everybody can handle that. And actually, Elon Musk is probably someone who's handled it very well, if you look at the way he sort of manages to get everyone inside. But again, it's the share price goes up and down because it's harder, because you're under a lot more scrutiny when it comes to
Yeah.
being public. So that'll be interesting to see how he sort of manages that. Because you look, like we've seen, the share price went up to 76 and now it's down to 40 again. So is this an up and down yo-yo? Is this going to be a long-term great play?
It'll certainly be worth watching. We'll have to keep an eye on, see how he performs as he settles into his role. Dutch Bros, as you said, it's been around for a while, but it's only recently become a public company. And as many other once private, then public companies have discovered over the years, that running the business is a very different process. As you said, there's a lot more scrutiny. There's a lot more regulatory oversight. There's less you can get away with. If
Yeah,
you're a manager and you don't live up to expectations, you're going to struggle to keep your job, because ultimately shareholders can vote you out. It's not very common, but there's plenty of examples where activist investors have come along and they have removed managers from their positions because they just weren't living up to expectations, and that can cause a lot of uncertainty and volatility in the share price. So we'll have to wait and see, I think.
yeah, definitely.
So we mentioned just briefly now, when we're talking about the original founder owning 74% of the voting rights. Now, in my experience, that's always been a bit of a yellow flag, because while it's good to have a founder in charge and it, eliminates the potential for bureaucracy on the board, it also can destroy the democracy of the boardroom as well. So if a decision is being forced through and it may not necessarily be the right one, it can end up having devastating effects. I don't know whether or not you think that's as big a risk as I do, but right now, if you had to name the biggest threat to this company, what would you think it would be?
I think it is this individual, because I think the business hasn't, and it seems to be, it's a bit like a cult. It seems to be like, culture and cult based, and it seems to be, and it hasn't really. I think a simple example is the fact that they don't do franchises. They're predominantly just company owned and company shops. So it's all around culture and having these young people work for them. So one of the things we haven't mentioned is actually the reason Gen Z people love it so much is because majority of the employees are Gen Z, are teenagers. So it's like, you're serving, it's like a community cool feel, but that's got problems as well. And it's the issue is this person going to be able to change that and actually scale this business further? Because you can it's only been it's done very well at 538 stores and 11 states, but is this a phenomenon where that's as big as it can be because of what it's trying to do? Can it really be? Can it be a McDonald's, for example? I mean, McDonald's has probably one of the greatest franchise models ever um, created, really, and it's done so extremely well because they've got checks and processes. Same with KFC or Yum Brands. These are businesses which have created franchise models, and you sort of wonder, well, to scale at 4,000 shops, you can't do that by owning all the shops. It just doesn't happen fast enough. So that's the question I have: is will he be able to lead that business? And when it goes public is the scrutiny of the public markets, because it's much more short term, and he's obviously had the ability to the luxury of
Mm.
owning so much of the company and having that. But when the share price tanks, is he going to have the stomach to handle those tough situations? And that's the risk. And then the others, like I said, is how do they stay relevant constantly with new teenagers coming in, and does that mean that the sort of the audience gets bigger and who they serve, and that might be sort of an issue. Yeah, so it needs innovation and problem solving. So it's yet to see, but those are sort of, I think, quite sort of quite fair questions to ask.
From the general impression I got from the report, despite the company being quite old, I mean, it's been around for quite a while now, even if its public life is relatively short, uh, it still has a lot to prove, and that can lead to a lot of volatility in the share price. Investors get overexcited, then disappointed, and then the cycle repeats itself, which is what we've seen, as we talked about earlier, is that the share price has been shifting from one end to the other of the spectrum. But obviously, with the report, you actually went ahead and did a valuation of this business. So
Mm.
Do you think the shares are currently too expensive now that they've come down, or is this actually a buying opportunity in your opinion?
So I think I looked at it and I did a number of different valuations. So we did our standard discounted cash flow, where I took the forecast of sort of what analysts were saying, which was, I took a consensus of, okay, next year they're going to do 700. They've done 500 this year. That's not too unreasonable 1 year out. I think
Mm,
analysts tend to have fairly good forecasts, and management tend to give good guidance on that. So that's not too crazy. And then I looked into sort of 2026, which would be sort of 4 or 5 years out, and took that sort of enterprise value of what that valuation would be at that point,
mm,
and I got to sort of 3 billion. And then I got a cost of capital, or what you're discounting those cash flows at, around 10%. And with that number, I got sort of quite a low number, around 23. And then I took and I did a sense check and said, well, what is this doing compared to the competitors? So we took the likes of Starbucks and others, and this business was trading at a higher multiple of like 5.62 times revenue, and the average for the industry was about 4 point something. And you just think, okay, fine, you're paying a higher multiple because you're expecting the higher revenue growth. But at the end of the day, this is still a brick and mortar business. It still needs to, from going from 536 stores to, well, I think it's 538, to sort of all the way to 4,000, is going to require quite a lot of things to work in their favor. And like
mm.
you say, is this just an expansion play of the new shops adding the value versus like for like? So we got to a valuation of around $30, which again is cheaper than what it is today. So the fair value is a lot lower, and I don't think at this prices it's something that you'd want to consider. Now that being said, sometimes you don't mind paying fair value for a stock or a bit more, because you say, well, it's a great business and it's a fair value, but for the long hold and the long term earnings potential of this business, it's a great hold. I don't think in today's market or world you can buy things for necessarily cheaper than they're worth. But if you can get closer to what you think fair value is today, and you see the potential, then it might be worth having in your portfolio. But yeah, this one just seemed a bit too expensive, and there's too many things, like we said, they need to get right, which gets me a bit worried about where things are going. They've only got stores in 11 states. Is it just a fad? And they benefited from the whole TikTok word of mouth, but how can they continue that? And are these sort of long-term strategies, or these sort of short-term wins?
Certainly a lot of questions for investors to consider, and whether or not Dutch Bros will be able to pull it off, we've yet to see, which is something which was reflected in your Cog score. It's not something we're going to give away. If viewers want to know what that score was or ended up being, they can obviously go to the report and have a look at it for free. The link is in the description below.
What's
And
It'd be worth maybe telling the viewers, but what is the Cog Score? Because those
yeah,
going to be watching this
so
for the first time.
as a
Yeah.
reminder, we explained this a bit last week, but we'll explain again. A Cog score is something we developed, and it's taking all the different aspects of the business. It's looking at the business model, the management, the culture, what it's trying to achieve, its market opportunity, and it compiles into a score that lies between 0 and 100. And the higher the score, the better quality we think the underlying business is. And we said this last week, we've never come across a perfect business. Everything has its issues. So if we do come across a business that's 100, has a score of 100, chances are it's too good to be true. I think in the premium service, that one of the highest scores we've seen so far is around 85.
Mm.
And Dutch Bros wasn't that high this time around, just because of the glaring questions coming out of it. But it definitely looked like it had the potential to provide success over the long term, assuming a lot of things go right.
Yeah, of course. And it's one to watch, and I think one to say, well, actually, it's an interesting business, something to watch. Has it got the right ingredients to sort of be that sort of 10x to 100x bagger? And then, which is the Cog score reflects that. And then, is the price there? So it might be a great business, but are we willing to pay that price for it? And I think that's where it's with anything, isn't it? You don't mind paying something a bit higher because you think it will be worth more in the future.
Time will tell.
This,
I think we can leave it there for this week. Thank you for spending the time with us today, Imran.
thank you.
If you have enjoyed this discussion and have any suggestions on topics you'd like us to talk about in the future, please leave a comment below. And we will see you guys next week.
Take care.